he will not be able to claim more than $5,200 in any 1 year. And so he's using it 90% for business, so you'll only be able to take 90% of that as well. And then only 90% of the other items that you see there for that, for the expenses related to his SUV. Then on number 6, you'll see that Betty, remember we said that she is a paralegal. You'll see the salaries from her 4 employers. Really and truly on your H&R Block software that you're using, it will not matter whether you take that and spread it over 4, or if you just put that on one W-2 for purposes of what we're doing for our return. That will not matter. Just remember that she will also have paid in some Social Security and Medicare tax. Just in other words, think of your W-2 and think of the items that would be on each one of those blocks. And then she has subscriptions, laptop computer, occupational license fee, some other items that are going to go on Form 2106. That's 2106, and it's going to be employee business expenses that will also go on her Schedule A. Yeah, but if you work through the 2106, you will be able to see at the bottom of that page where it tells you where to take that to the miscellaneous itemized deductions on your Schedule A. Also, she has a laptop computer that she will be able to take depreciation on. And that will also need to go on a 4562 depreciation schedule as well. We go to number 7, and we see that, oh, and by the way, the miles that she has there, the 813 miles, she will get to deduct that at 50.5 cents, at 0.505, for purposes of going on the Form 2106. I posted a discussion board forum post about that and shows you the various mileage rates for 2008. We get into number 7. This can be found in Chapter 11, pages 17 through 19. He has some rental income with some other expenses that he had. This will go on a Schedule E. The rents that he will receive, that he will report on line 3, is going to be $28,600, and this is going to be his rent, again, on Schedule E. Now he's going to have 13 months worth because he received 1 year in January 2009, his renter prepaid the January rent, and he received it in December of 2008. So remember, the same reason that we picked up on item 2, he's a cash basis taxpayer, so he will show 13 months worth of rent in 2008. Assuming that they don't get a prepay the following year, he would only have 11 months then that would show in 2009. Also on his property, he's going to have a basis of $220,000 plus the $80,000 in renovation, so he's going to have a depreciable basis of $300,000. If you'll look at Table 8.6 in your book, 27.5-year residential real property, the percentage would be 3.636%. So the depreciation allowed for 2008 is going to be $10,908. The basis in personal property is going to be $38,000. Again, in Table 8.1, 19.2%. So for depreciation allowed of personal property is $7,296. And to give you a check figure for Schedule E, you will have $2,896 will be your net rental income after you take in your receipts less your expenses. Now we move on to 2008. At issue here is worthless stock. On page 7-6 in your textbook, it explains worthless stock, and it will be short-term capital loss, which will be on Schedule D. And many of you have asked me about Schedule D, and hopefully we'll be able to get this to where you can see this. On Schedule D, you have short-term items that will go on the top, and you have long-term items here. You will simply put the description, you'll put the date acquired, and the date that it was sold or disposed of, your selling price, and the cost or your basis to give you either a gain or a loss. You will add those up, and at the bottom, at the bottom it will tell you exactly where to take that to for your tax return. Now, in this situation, he had done some business and agreed to take some stock as payment for that business of $3,900. So that's going to be his basis in the worthless stock. So on the Schedule D, you will put the date acquired would be March 7th, 2007. The date that he declared it worthless would be, it doesn't really matter, it doesn't say here, so it's going to be one of those times that you've got to assume any time in 2008. I would even just put December 31st, 2008 will be the date that he disposes of it or declares it as being worthless. So he's going to have a $3,900 loss here. But remember, we're going to have to take that and put it on our Schedule D and see how that plays out. You can only take $3,000 of losses over and above what your gains are for the year. So that will be a short-term capital loss. In number 9, on March 10th, 1990, David's father gave Louise a tract of land for $150,000. Now, on page 13-32, this is going to be a like-kind exchange. It will go on Form 8824. If you go to 13-32, it's going to walk you through exactly how to figure that gain or loss on that like-kind exchange. We've got some boot involved here. $8,000 in cash. That's going to be boot in this case, okay? So make sure that you fill out Form 8824. At the bottom of 8824, it's going to show you exactly what line item on Schedule D that you will take that to. And then on item 10, this is a Schedule D, and it's going to be a long-term capital gain. It will go in Part 2 of your Schedule D. He will have a basis because he got this at his father's death, remember, and the date of death, the fair market value was $22,000. That's going to be David's basis in the property, so that will go under your basis, which is column E on the Schedule D. The selling price is $29,000, so he's going to have a $7,000 long-term capital gain on the transaction in D. Then on 11, this is going to be an installment sale. You will need to report this on Form 6252 in Chapter 16, pages 20 through 22 in Chapter 16 tells you exactly how to figure the installment sale. Again, on Form 6252, when you enter everything in, it's going to show you exactly where to take that over to your Schedule D that you will have. And then we need to keep in mind in 12, it's telling you that the Lees had some carryover. In 2007, they ended up with a net short-term capital loss of $7,000. Of this loss, $3,000 was deducted in 07, so they've got a $4,000 carryover of a loss to 2008, and that can be carried over. So we'll start off with a short-term capital loss in 2008. Going on over to number 13, we see that Betty's widowed mother, Vivian Newman, lived with the Lees. She will qualify as a dependent. December 30th, 2007, she suffered a heart attack and died in early February of 2008, so she will be a dependent for 08. We will be able to deduct the top three items as medical expenses. from her, or for her, as being paid out. Well, I'm sorry, the burial expenses will not be deductible. I was getting ahead of myself. The burial expenses are not deductible, okay, expenses for tax purposes. But the medical expenses in 2007 and 2008 were not paid until 2008, so we can deduct those as medical expenses. And then the church pledge, because the Lees paid that on her behalf, they will be able to deduct that $600 as a charitable contribution on their schedule letter. And then you see it, besides personal and household effects, Vivian's major asset was life insurance, and she designated the beneficiary of the policy to be Betty, and it was paid $20,000 proceeds that Betty received. On page 5-7, you will find in your book that the receipt of those life insurance policies are not going to trigger a taxable transaction, and so they are not taxable.